Our first guest says he sees the jobs market softening but not collapsing, and that points to gradual Fed easing. Let's bring in EY chief economist Gregory Daco. Gregory, great to have you with us. So Waller's comments about front loading, you don't buy that. You think 25 still?
I still think 25. I think now the question is how fast they will go after September. I think policymakers in general are on board for a gradual onset to the easing cycle. They continue to talk about a methodical approach. And this jobs report, which all eyes were on this morning, does not indicate any form of collapse in the labor market. We had an encouraging jobs print after the July miss last month. We had a rebound in hours worked, and we had a slight downtick in the unemployment rate. Yet, I think the most important gauge, in my opinion, is a 3-month moving average of payroll growth, which is at 116,000 jobs only, well below trend, which indicates that the labor market is visibly slowing. So while I don't think Fed policymakers will proceed with a large 50 basis point rate cut, I think they should accelerate the pace of policy recalibration because monetary policy is too restrictive right now.
What do you think the risk of recession is at this point, or are you still expecting as a base case scenario a soft landing?
I think we've been in a soft landing camp for the better part of the last year, really. We've seen inflation come down quite easily. That was the main aim of the Fed's restrictive monetary policy stance. As we look forward, we're seeing an environment where disposable income growth has slowed quite a bit, only 1% year-over-year growth as of July. That is the key pillar to consumer spending activity. So consumers are still spending as of mid-year, but the underlying drivers of consumer spending are weaker. That's really the key element to pay attention to. I don't think we're headed into a recession right now. What we are seeing is more prudence on the part of consumers that have lower income momentum and on the part of businesses that are being a little bit cautious given the still high interest rate environment and the uncertainty on the political front.
So, Greg, walk us through when you look at inflation, and everyone talks about CPI, or what that level of inflation is. Walk us through that calculation you do with wage growth that is not consistent with a 2% or an above 2% inflation rate.
Yeah, I mean, the main point of discussion last year and the year before that was whether wage growth was inflationary. And the notion is that wage growth is inflationary when it's above 3.5%. And that's a simple calculation. It's 2% inflation, which is the Fed's target, and 1.5% productivity growth. But right now, what we're seeing, and this is perhaps the most encouraging element of the U.S. economy, is that productivity growth is very strong. You're looking at productivity growth around 2.7% year over year as of the second quarter of this year. Add 2.7% productivity growth to the 2% inflation target, that puts you at 4.7, which would be wage growth that is consistent with the 2% target. We're currently running around 3.8 as of the latest payrolls report. So we're under the pace of wage growth that would be consistent with inflation. So we're not seeing any inflationary momentum, in short, coming from the labor market today.
Greg, thank you. Great to see you. Greg Daco,
Always a pleasure.
EY.